we are entering into another session where we are going to discuss about shares itself, but as I have said, we have different types of shares and we have already seen what is equity shares. Now we are going to see the second type of shares, that is preference shares. So in this session we will be discussing about what is preference share. Now once again we will be going shares, unit of capital is called share, and each share has a nominal value. Capital collected is called share capital. Person who is holding the share is called a shareholder. Again, I said types of shares. Shares are classified into equity shares and preference shares. We have already seen what is equity shares. Equity shares are those shares which are representing the ownership of the company. So in this session we are going to see what is preference shares. Preference shares are those shares which are having some preferential rights, which provide some preferential rights to shareholders, and in two cases they are having preference. They are given priority. One is regarding receiving fixed rate of interest. They receive a fixed rate of interest. They will be paid an interest. And second one is preference in repayment of capital. They will be having preference when compared with equity shareholders. They will be having preference in payment of interest, receiving fixed rate of, it is not interest, it is dividend. It is dividend. It's a mistake. It is not interest, a fixed rate of dividend. Receiving fixed rate of dividend and repayment of capital, they will be preferred. They will be given preference when compared to equity shareholders. That is why it is called as preference shares. And preference shares doesn't have any voting right. They have no right to participate in management. They doesn't have ownership. They receive payment. They receive the payment, the dividend they will receive, the principal amount they will receive. There they will be having preference, but it doesn't have ownership. Those shares doesn't provide ownership to the shareholders. And capital raised through this source is called as preference share capital. Capital which is raised through the source of preference shares, we call it as preference share capital. So basically, to understand, this is what you have to keep in mind. It is having preferential position and preferential position in receiving fixed rate of dividend and repayment of capital. These two cases they will be given preference compared to equity shareholders, or before equity shareholders they will get paid. Now going on to the merits. Merits of preference shareholders. First and foremost merit is that it provides steady income, because fixed rate of dividend to be paid. So they are receiving fixed rate of dividend, and they, whenever there is earnings, they will get paid that fixed rate. Fixed rate will be paid to equity shareholders when there is income. So what to say? Preference shareholders are there is a safety of investment. There is a safety of investment, because for the investment what we have made, they will pay a fixed rate of dividend. And one more thing is that the fixed rate of return with low risk. Low risk is another factor. They will receive a fixed payment and they don't have to assume risk as equity shareholders. Only when they are having, or they will be paid only on the basis of earnings after all the settlements are made for equity shareholders. But here, before equity shareholders, they have to be considered. So comparatively risk is less and fixed rate of return they will receive. Third one, it doesn't affect the control of equity shareholders, because preference shareholders doesn't have ownership in the company, whereas equity shareholders are having. So preference shares, issuing preference share doesn't affect the control of the company or doesn't affect the control of equity shareholders, because preference shares doesn't have ownership rights. Fourth one is can be beneficial for equity shareholders at good times for higher dividend, because preference shareholders is to be paid only a fixed rate of dividend, whereas equity shareholders can have whatever is remaining. If earnings is more after making payments, whatever is remaining, it is for equity shareholders. So as this is having a fixed rate, whatever is remaining, it is meant for equity shareholders. So equity shareholders can be benefited after paying that particular fixed rate to the preference shareholders. So it can be indirectly beneficial for equity shareholders. Fifth one, enjoys preferential rights regarding repayment of principal amount and dividend. They are having preferential rights. No charge on assets. There is no assets are given as securities while purchasing shares. No charge is created. So that is yet another merit. Coming on to limitations, it is not suitable for investors who are ready to take a risk and expect to get returns, because here the returns are fixed and here there is no much risk is there. Here it is almost sure that you will get paid. So it is not suitable for investors who want higher returns. Who want higher returns, better don't go for preferential shares. Preference shares, they will get only preferential rights but no high return, fixed rate is given. So this may not be good for those shareholders who are expecting higher returns. They must surely go for equity shares. Second one is dilute claim of equity shareholders, because preference shareholders have to be considered before settling equity shareholders. So if there are more equity shares or more equity shareholders, they have to be paid first, and only if there is something remaining to be paid to equity shareholders, they will get paid. So there is a chance that there can be a dilution regarding the payment to equity shareholders. Equity shareholders may not get after making payment to preference shareholders. So there can be a dilution of claims. Third one is dividend on preference share is high compared to interest. Cost of preference share is more when it is compared to cost of debenture. Debenture is another source of income. That is a kind of borrowing where we have to pay interest for that borrowing. When we are comparing this debenture and preference share have more cost, because more dividend has to be paid to preference shareholders, whereas debenture interest is comparatively less. And last one is there is no tax saving, or the payment of dividend cannot be deducted from profit, and yet no tax benefit is there. So in that way also it is a shortcoming. It cannot be shown as an expense. So no tax benefit is there for preference shares. So these are the limitations and merits of preference shares.